Welcome to AI Explains ICT. Today, we are diving deep into a really powerful concept from ICT's core content, specifically Month 4, Episode 4. We're talking about the mitigation block. Now, this is a huge piece of order block theory, so you might want to grab a notebook for this one. All right, let's jump right in. You know that feeling, right? You see this huge market move, the exact one you were waiting for, and it just takes off without you. It feels like you've totally missed your chance. But what if I told you that initial breakdown wasn't the end of the story? What if it was actually setting up a second chance, maybe even a better one? Well, that's exactly what the mitigation block is all about. So here's the game plan for today. First, we're going to decode what a mitigation block even is. Then we'll look at the M patterns so you know exactly how to spot it. We'll get into the institutional mindset, the why behind the move. Of course, we'll look at a real-world example on a chart, and then we'll tie it all together with a simple trading setup.
Okay, let's get into it. First up, what is this thing and why does it matter so much?
Okay, so here's the deal. A mitigation block isn't just some random line on a chart. Think of it more like a footprint. It's a clue left behind by the big institutions. See, when a bunch of traders get trapped on the wrong side of a move, their positions are deep underwater, the market has this funny way of coming back to give them a second chance, an opportunity to get out, to liquidate, or to mitigate their losses. That's the keyword right there. But here's something you absolutely have to remember. You can't just hunt for these patterns in a vacuum. It all starts with context. You must have a clear directional bias first. Are you bullish? Are you bearish? You need to know that before you even start looking. For the sake of this video, we're going to focus on a bearish scenario, so we'll be looking for prices to head lower. All right, so what does this actually look like on a chart? Well, visually, it creates a shape that's pretty hard to miss once you know what you're looking for. And there it is, the classic M pattern. See how it works? Price makes a high, it pulls back, and then it tries to rally up one more time, but it fails. It can't make a new high. That little moment right there is called the failure swing. But the real confirmation, the big signal, is when price then smashes down and breaks below that prior low. That's what ICT calls a market structure shift. And that, my friends, is our first major clue that smart money is starting to sell. Okay, now pay close attention here. See that little short-term rally inside the M pattern? From that short-term low up to the short-term high, that whole range, that's our mitigation block. So why is that important? Well, think about it. Anybody who bought in that little zone thinking, hey, this thing's going higher, they're now completely trapped. The floor just fell out from under them and they're holding a losing trade. So once we get that market structure shift, that confirmation we were talking about, we can really start to zero in. We're going to look at that short-term low that just got broken, and we're looking for one very specific thing, the last down candle right before that little trap rally began. That single candle becomes our new point of interest. It's the high-precision spot we're going to be watching for an entry. Okay, so we know what to look for, but the bigger question is, why? Why does price so often come back to this exact level? This is where things get really interesting, because it's all about understanding the institutional game. Take a look at this ABC swing. The folks who bought from point A up to point B were feeling pretty good for a minute there, right? But then, bam, price collapses from B all the way down to C. All those happy buyers are suddenly in a world of hurt. So that return trip, when price comes back up to point A, that's not random. It's a lifeline. It's a second chance for all those trapped buyers to scramble out of their positions at break even. They're just happy to get their money back. And all of that selling from people just trying to get out creates this fresh wave of pressure, pushing the market back down. You've probably heard that old trading saying, what was support becomes resistance, right? Well, this is the institutional logic behind that idea. It's what ICT calls buyer's remorse. Those traders who bought at the old low are just kicking themselves. So when price comes back and gives them a chance to get out without a loss, you better believe they're going to take it. And guess who's waiting there? Smart money. They know this is going to happen, and they use all that get-me-out selling as liquidity to build up their own short positions. And this quote from ICT, it just hits the nail on the head. Premium price highs are bought by less informed traders and sold by smart money. These little rallies, these trips up to premium prices, they are so often just a trap. They're designed to suck in buyers right at the worst possible time. When you learn to spot these mitigation setups, you start trading with the smart money, not against them.
All right, enough theory, that's all great, but let's see what this looks like on a real live price chart.
Okay, so check this out. On this chart, you can see it plain as day. The market tried to make a new high, it failed,
And then we got a clear breakdown. So boom, we have our bearish bias. Now as price starts to fall, look at how it breaks through those previous short-term lows. Every single one of those broken lows is now on our radar as a potential mitigation block. We're watching those levels like a hawk. And what happens next? Just look at that. Price rallies right back up into one of those old broken lows. And it's not just any level. It goes right to the last down candle before the break. For any trader who felt like they missed that first big drop, this is your second chance. This is the high probability short entry that the mitigation block serves up on a silver platter. And here's a little pro tip from ICT that you'll want to write down. A really strong, valid mitigation block often sees price trade up into the candle, but it respects the body. It doesn't even need to poke through the high. That kind of precision, that's your clue that the institutional selling pressure at that level is incredibly sensitive. It's a huge tell. Okay, let's bring this all home. I'm going to wrap everything we've talked about into a simple, step-by-step framework you can actually use. So here it is, your 5-step checklist. Number 1, you got to establish a clear directional bias. Let's stick with bearish. 2, identify that market structure shift, that break of the low. 3, isolate the last down candle in that prior low. That's your point of interest. 4, this is the hard part. You wait. You patiently wait for price to come back to that candle. And finally, number 5, you define your trade. You know your entry, you place your stop just above the block, and you set your objective for a lower price. And you know, this really gets to the heart of the whole thing. The market is always leaving behind clues about what the big players are doing. When you understand a pattern like the mitigation block, you stop being the person who gets trapped by the move, and you start becoming the person who anticipates it. So, I guess the only question left is, which trader are you going to be? Hey, if you got some value out of this breakdown, do me a favor and hit that like button. And make sure you subscribe so you don't miss any more deep dives into ICT's concepts. And seriously, if you have any questions at all, just drop them in the comments below. We have a real human who reads and replies to them. Until next time, good luck out there and safe trading.